So I think we first need to define some sort of a framework to make decisions around international investing, just like we do it domestically. I think somehow the frameworks for international tend to be thought about differently from the frameworks for domestic, which should not actually be the case. It's a allocation decision that investors are ultimately making, saying that out of my pool of 100 rupees, how much am I willing to allocate to domestic assets and how much am I willing to allocate to international assets. Now let's go back to what are mutual funds, right? Mutual funds are essentially instruments to delegate money management. So you decide that I can't do this role. There is some professional who does a better job than I do. And therefore, to me, anyone who wants to delegate their money management, whether it's domestic or international, looks at a mutual fund as the route. If you look at an ETF, what does an ETF do? It basically is a low-cost, rules-based system. So you know exactly what the rules are. They're set on the basis of an index. And because they're set on the basis of an index, you just follow that index and get a low-cost solution. Also manage your emotions along the way because it is rules-based. And then when you get to direct stock, what you're taking over control of is essentially the management of the money, as well as the governance and frameworks within which you will manage risk. I think once you're clear that this is the sort of framework that exists between mutual funds, ETFs, and direct stock, you then start to say that for which of my clients is each of these appropriate. So maybe for a retail investor, a delegated model might be the most efficient model because that investor is not looking for optimization often, is looking for simplicity. So maybe a mutual fund structure is very good for that individual. A HNI investor might actually look at things a little differently, saying that I need market returns or market beta, plus I need something over and above that. And therefore, I might look at ETFs plus an active component on top of that to get some better returns. I think there's enough data available for us to all see that globally, if you look at the latest S&P 500 data that's got published, this PIVA report, you'll find that 79% of all large cap funds have underperformed the index.
You're talking about Indian or global?
US.
US, okay.
And global markets, it's 76%. Okay. So clearly the numbers are not in your favor when you go to active management. Maybe there are great active managers out there, but the numbers are not in your favor. So you need a core to be built through ETFs, and then you get the spice, I would say, through the active management. Now, if you're a family office, you have an investment architecture that you're trying to build together. And in those cases, you might find that stocks could be a very powerful way because you're trying to create limits within your investment architecture. You're trying to do sectoral allocations. You're trying to make investment choices. I think one of the mistakes that we see is that when people think about global portfolios, they're thinking about familiar brand names. That's not what global investing is about. It's about saying that in my framework, how do I get access to truly global businesses? So what if I don't know the names there? And you can get that only through ETFs or through funds because those are more diversified rather than just creating a tech-heavy, AI-driven, brand familiar sort of portfolio.
Okay.
Disclaimers: investment in securities market are subject to market risks. Read all the related documents carefully before investing.